Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lightwave logic.
If you find our talks useful, please consider subscribe, like, and comment underneath. And hey, just a quick reminder, the VIP Algos link is below in the description. You definitely want to check that out to get an edge in your daily market strategy.
Yeah, it's an incredible tool. Highly recommend looking at that. So to really build our wealth building context today, I want you to imagine a bustling little neighborhood coffee shop. They are pulling espresso shots, selling a few pastries, and maybe they pull in around $30,000 over a busy quarter.
Right, a solid little local business.
Exactly. Now imagine Wall Street looking at that corner coffee shop and suddenly valuing it at hundreds of millions of dollars.
Okay, wow.
Yeah, that is the exact paradox we are looking at today with Lightwave logic, ticker symbol LWLG. If you look at their first quarter revenue for 2026, it sits at exactly $29,000.
Wait, 29,000, not million.
Nope, $29,000 total. Yet, this is a stock that has surged roughly 167% year to date. It's actually delivering a 7 times return over the past year.
That is wild. I mean, it creates this fascinating cognitive dissonance for anyone actually looking at the balance sheet. You see those numbers and you instinctively look for a typo.
Right. You think you missed a few zeros.
Exactly. A publicly traded tech firm pulling in $29,000 in a quarter while commanding this massive premium valuation just feels entirely disconnected from financial reality.
It does, but you have to understand, the market isn't looking at what Lightwave logic is selling today. Investors are heavily pricing in the probability of what this company might fundamentally own tomorrow.
Well, if people are throwing this much capital at a company with basically micro revenue, there has to be a really compelling scientific narrative underneath it all. I really want to look past that confusing financial surface and get into the actual fundamentals and the technology.
Oh, absolutely.
Because, if you are following the AI space right now, it is so incredibly easy to get distracted by the big players making the massive, expensive AI chips. But the reality is, those chips are hitting a physical bottleneck.
Yeah, and the bottleneck isn't computing power anymore. I mean, we've basically solved that. The bottleneck is movement.
Movement of the data.
Right. Think about what happens when you query a massive large language model. Millions of computations trigger instantly, and mountains of data have to travel between servers in the blink of an eye.
And to do that, the industry relies on optical transceivers.
Exactly. These are essentially the vital bridges in a data center. They translate the electrical, sort of the brain signals of the server into optical signals, which is light. So the data can actually travel over fiber optic cables.
Because fiber optics are standard, since light is just infinitely faster than pushing electricity through a heavy copper wire.
Right, you get way more bandwidth. But the transceivers themselves, the actual physical devices doing that translation, they rely heavily on traditional materials, stuff like silicon or lithium niobate.
And that reliance is where the entire industry is suddenly hitting a massive wall.
Yeah, because silicon and lithium niobate are rigid crystalline structures. To change their optical properties, to actually encode or modulate that data onto a beam of light, you have to hit those materials with a ton of electrical force.
Which the industry calls the drive voltage.
Exactly. Because silicon is so rigid, it takes a really high drive voltage just to force it to modulate the signal.
And hitting something with a lot of electrical force generates a massive amount of heat. Not to mention, it requires huge amounts of power.
Oh, massive amounts.
So traditional silicon is basically like this heavy, rusted physical switch. You have to use a lot of muscle, a lot of power, just to flip it back and forth to send a signal. And because it's so heavy, you can only flip it so fast before you just max out your physical limits.
That is a perfect way to visualize it.
Yeah.
You are burning power to fight the physical rigidity of the material itself. And that inherently caps your modulation bandwidth, meaning it caps how fast you can actually send data.
Okay, so this is where Lightwave logic's primary fundamental intellectual property comes into play.
Yes. They have developed this proprietary class of electro-optic polymers that they branded as perkinamine.
Perkinamine, got it.
Right. And unlike those rigid silicon crystals we just talked about, these organic polymers are engineered at the molecular level. So when a tiny, tiny electrical field is applied to perkinamine, its refractive index changes almost instantly and effortlessly.
Okay, so if silicon is that heavy rusted switch we talked about, perkinamine is basically a digital dimmer switch. It requires barely a tap to operate, meaning you can modulate it infinitely faster without completely exhausting your power supply or melting your expensive hardware.
You are fundamentally changing the physics of the transceiver at that point. You achieve this incredibly low drive voltage, which saves massive amounts of power, while simultaneously unlocking extremely high modulation bandwidth.
Which is huge for AI data centers right now. I mean, they are currently consuming literal gigawatts of electricity just to keep the lights on and the servers cool.
Yeah, solving both speed and power consumption at the exact same time is essentially the holy grail for the industry.
Well, I can see why the tech sounds completely revolutionary on paper. But we have to be realistic and address the elephant in the room regarding organic polymers.
The reliability issue.
Exactly. They are basically advanced plastics, you know?
Right.
Historically, the big knock against using polymers in high-performance computing infrastructure is that they degrade over time.
Right.
Data centers are notoriously hot, hostile environments. If you put a plastic-based transceiver into a sweltering server rack, doesn't it just warp or melt after a few months?
Well, that specific historical concern is exactly what has kept electro-optic polymers relegated to just being cool science experiments for decades. Reliability has literally always been the missing ingredient.
But something changed recently.
Yes, the recent data points to a major milestone for Lightwave logic that essentially rewrites that entire narrative. They recently passed the Telcordia device-level stress testing.
Now, I imagine that is a fairly brutal gauntlet for an organic material to run.
Oh, it is the absolute gold standard for telecom and data center reliability. To pass it, the materials have to endure 85 degrees Celsius, which is about 185 degrees Fahrenheit and 85% relative humidity.
Wow. For how long?
For thousands of hours.
Yeah.
Without their optical properties degrading at all. Normal organic compounds usually swell up, warp, or just completely break down under those kinds of conditions.
But perkinamine survived it.
It did.
Yeah.
Passing the Telcordia 85 test finally proved to the entire industry that this polymer is commercially viable. It won't melt when deployed at massive scale.
Okay, so the science works. It survives the heat and the humidity. But let's transition to the catalysts and how a cool polymer actually becomes a profitable business.
Right, because Lightwave Logic isn't building data centers themselves.
Exactly, and they aren't even manufacturing the optical transceivers. So what is the play here? Are they just planning to sell big buckets of high-tech polymer goop to tech companies?
No, moving from a lab breakthrough to a commercial enterprise is notoriously difficult in the semiconductor space.
Right.
Their strategy is actually much more sophisticated than just selling raw materials.
Okay, how so?
They are heavily focused on ecosystem lock-in. They want to embed their polymers directly into the global manufacturing supply chain. Specifically, they are integrating into what the industry calls process design kits, or PDKs.
Okay, so when you say ecosystem lock-in through a PDK, I imagine that's because foundries, the massive factories that actually print the silicon chips, are incredibly specialized. You can't just hand a foundry manager a generic blueprint and a bucket of polymer and ask them to whip up a chip.
Not at all. A PDK is essentially the definitive, highly specific recipe book for a specific foundry.
Right.
It dictates the exact electrical, physical, and optical constraints of that specific factory's multi-million-dollar photolithography machines. So if an engineer at a big tech company wants to design a new AI chip to be manufactured at a specific foundry, they have to use that foundry's exact PDK to design it.
And Lightwave Logic is getting their polymer into those recipe books.
Exactly. They are actively integrating their polymer materials into the PDKs at 4 major global foundries right now: Tower Semiconductor, Global Foundries, Silterra, and AMF.
That sounds incredibly difficult. I mean, getting an organic polymer approved inside a pristine silicon cleanroom environment sounds like a logistical nightmare. The foundries have to be absolutely certain this new material won't contaminate their existing silicon wafer production lines.
Oh, it takes years of calibration and testing, which is exactly why securing 4 major foundry partnerships is such a massive catalyst signal to the market. But the real genius of this strategy is the switching cost it creates.
Ah, right. Because if a chip designer builds their next-generation transceiver architecture based on the specific refractive index and performance specs of Lightwave's polymer inside that PDK.
They are completely tethered to it.
Right. You can't just randomly swap out the core material halfway through without basically redesigning the entire chip from scratch.
You are effectively permanently written into the DNA of that chip. Once you are in the PDK and a customer designs around your tech, it is painfully expensive and incredibly time-consuming for them to ever switch to a competitor.
Which perfectly explains the long-term moat. But rewriting recipe books at massive global foundries obviously takes years.
Mhm.
Are they actually seeing any revenue from this integration phase right now? Because that brings us back to that $29,000 they made in Q1 of 2026.
Right. Management has been very clear that their target for actual production revenue, meaning the high-volume sales and royalties from commercial chips, isn't actually expected until the second half of 2027.
Okay, so H2 2027 is the real money.
Exactly. The $29,000 we are seeing right now consists of non-recurring engineering fees, or NREs, and some minor prototype sales.
So basically, the foundries or early tech partners are paying them small sums to help engineer these initial test integrations. It is validation revenue, not scaling revenue.
Precisely. It's proof of engagement, which is great, but it obviously doesn't pay the daily bills.
Which means we really need to look at the financials and their survival skills. With the big commercial payday not scheduled until late 2027, how much runway do they actually have? Because in Q1 of 2026, alongside that tiny revenue, they posted a net loss of $6.3 million.
Yeah, that breaks down to an earnings per share of -4 cents.
Burning over $6 million to make $29,000 is a pretty tough pill to swallow for any investor.
It is, but if you look under the hood of that cash burn, $3.5 million of that went directly to research and development. And honestly, for a pre-commercial deep tech company, aggressive R&D spending is exactly what you want to see. You want them perfecting the science.
Right, but the standout metric for me was their general and administrative expenses, which hit $3.3 million. That is a 77% increase year over year.
Yeah, that is a big jump.
A 77% jump in administrative costs for a company that isn't even producing commercial volume yet is steep. But I suppose navigating the legal frameworks, the intellectual property protection, and the global travel required to integrate into 4 different international foundries, it requires massive operational overhead.
Absolutely.
But the real question is, how long before the bank account hits zero?
Well, the good news is they are heavily capitalized for this exact phase. They finished Q1 2026 with $75 million in cash, and by May 11th, that cash position had actually strengthened to approximately $100 million.
$100 million in the bank. Okay, well, if we annualize that 6.3 million quarterly burn rate, let's just call it roughly 25 million a year.
Right.
That gives them about 4 years of purely operational runway. That easily bridges the gap to their H2 2027 commercialization target. That should alleviate any immediate panic about them keeping the lights on.
It completely removes that existential dread that usually haunts pre-revenue tech stocks. They can focus entirely on the foundry integration without desperately hunting for venture capital every 6 months.
And yet, if you look at the technicals and the sentiment, the stock chart for Lightwave Logic looks like a heart monitor during a panic attack.
It really does. It is a highly volatile asset.
I mean, it dropped 25.7% over just a 30-day window recently, falling into the $9.23 to $9.78 range. But even with that steep plunge, it was still up over 44% looking at the 90-day window.
The volatility is staggering, honestly. And it just speaks to the premium investors are willing to pay for future potential. The stock is currently trading at an 18.5 times price-to-book multiple.
Wow.
Yeah, the average for semiconductor materials companies is generally around 2.6 times.
So people are paying an astronomical multiple for zero current sales. Yet, you have quantitative models like over at Simply Wall Sates projecting a $74 fair value for the stock, claiming it is 87% undervalued purely based on the potential of these AI Photonics partnerships.
Yeah, valuing a stock at $74 when it's currently trading around $9.50 shows just how binary the situation is. It is entirely boom or bust.
Well, the market is obviously weighing 2 extreme outcomes. If the technology fails to scale in the foundries, the stock is basically worth its cash on hand. But if perkinamine actually becomes the default material for the entire AI data center upgrade cycle, $74 might actually be a conservative estimate.
Which brings up the exact timeline. If the stock is trading purely on these future binary outcomes, investors must be looking for near-term validation. What is the immediate catalyst on the calendar that could justify this high sentiment before we get all the way to 2027?
Well, the primary catalyst everyone is watching is scheduled for Q3 of 2026. Management expects to actually receive the first silicon chips back from current customer tapeouts at the foundries.
Right, and for anyone unfamiliar with semiconductor manufacturing, a tapeout is basically the final milestone of the chip design process. It is the moment the digital architecture is totally finalized and sent off or taped out to the foundry to be physically printed onto a silicon wafer.
So in Q3, the physical printed chips that have incorporated Lightwave's polymer into their architecture will literally come back from the factories.
Yes, and this is the ultimate, undeniable proof of concept. If those chips perform as engineered, it proves that Perkinamine can successfully survive the brutal, large-scale manufacturing process without losing its unique optical properties.
That Q3 taped-out return is basically the ultimate checkpoint. If the chips come back flawed, the H2 2027 timeline is dead in the water. But if they come back and hit their performance metrics, that theoretical ecosystem lock-in suddenly becomes concrete reality.
And that reality is converging with a massive macro tailwind right now. The total addressable market, or the TAM for AI and data center optical transceivers, has been radically revised upward recently. Current forecasts project a $47 billion TAM by 2028.
$47 billion. That is insane. Previous estimates had that market hovering around just $17 billion.
I know. That explosion in demand is entirely driven by data centers upgrading to 1.6T and 3.2 transceivers.
Yes, 1.6 terabits per second. When you are moving data at that immense speed, traditional silicon just generates way too much heat and requires way too much power to be economically viable anymore.
Right. Lightwave's low-voltage, high-bandwidth polymer isn't just a nice upgrade at that point. For speeds of 1.6T and beyond, it is increasingly looking like a structural necessity.
And when you have a foundational technology solving a $47 billion bottleneck, you inevitably start hearing M&A whispers, mergers and acquisitions.
Oh, of course.
A company with $100 million in the bank and a multi-billion-dollar solution seems like prime prey for a massive semiconductor giant wanting to vertically integrate.
Well, the landscape is already shifting in that direction. Marvell, which is a massive titan in the semiconductor and networking space, they recently acquired a company called Polariton.
Okay, so why does that matter for Lightwave?
The reason this raised eyebrows across the entire industry is that Polariton has been a long-time established customer of LWLG's polymer materials.
Wait, really? So Marvell just bought one of Lightwave's end users?
Yes.
Oh, I can totally see why the rumor mill is spinning. Marvell now effectively relies on Lightwave Logic for the raw materials feeding their newly acquired subsidiary.
Exactly. Lightwave's management explicitly addressed this, stating their goal is to just maintain the partnership and remain a critical supplier to Marvell. But come on, the strategic logic for an acquisition is hard to ignore.
Absolutely. If you are Marvell and you want to dominate the AI data center build-out, owning the proprietary electro-optic polymer IP outright gives you a massive competitive advantage over other chip designers who would have to license it.
It paints an incredibly optimistic picture. You have an expanding $47 billion TAM, a critical proof of concept arriving in Q3, and M&A speculation establishing a narrative floor under the stock.
Yeah, but given how wildly speculative this valuation is, we have to look at the structural risks and the bear case that could derail the entire thesis. Let's dig into the risks.
We definitely should. The most immediate structural risk hanging over shareholders right now is the threat of dilution. On June 11, 2026, the company filed an omnibus shelf registration, specifically a Form S-3.
Hold on a second. We just talked about how they have $100 million in the bank and 4 years of runway, right? So why in the world would management file paperwork that puts shareholder dilutions squarely on the table? An S-3 shelf registration basically allows a company to register a massive block of new stock with the SEC, but they put it, quote-unquote, on the shelf.
Yeah, they don't sell it all at once.
Exactly. They gain the legal right to sell those shares into the open market gradually over a 3-year period. But still, if you have a massive cash cushion, why signal to the market that you might print more shares? Are they anticipating massive hidden costs with these foundry integrations?
Well, it is technically a standard corporate finance maneuver to maintain ultimate flexibility, but your skepticism is completely warranted here. Ramping up commercial production from a prototype to a global scale is notoriously expensive, and it is incredibly prone to supply chain shocks.
True.
Having the S3 active gives management the ability to instantly tap the equity markets if they suddenly need emergency capital without jumping through hoops.
Yeah, but the mechanics of an S3 create this massive psychological ceiling for the stock. The market knows that if the stock price suddenly spikes on a great press release, management might just pull those shares off the shelf and flood the market to raise cash.
Which instantly dilutes the value of every existing shareholder's slice of the pie.
Exactly. It completely caps the upside momentum. Institutional investors absolutely hate the overhang of potential dilution, especially when they are already paying a steep premium for the stock.
And beyond the financial engineering risks, the raw execution risk here is immense. We have to talk about commercialization delays.
Right, because we keep saying this is a pre-revenue company. They had roughly $236,000 in full-year sales in 2025.
Yeah, any friction in customer qualification, any flaw in those Q3 tape-out chips, or any delay in the foundries scaling up production, and that H2 2027 timeline completely shatters.
And because the stock is priced for absolute perfection right now, if investors realize they suddenly have to wait until 2028 or 2029 for commercial revenue, the market will reprice this equity violently downward. That is the inherent danger of trading on binary commercial outcomes.
It is. However, it is really important to balance that bear case with the technical de-risking we've actually seen. Passing the Telcordia heat and humidity tests and securing integrations at 4 global foundries proves the underlying science works. The question is no longer about the physics. It is entirely about the manufacturing execution at this point.
So, distilling everything we've looked at today, what is the final verdict? How does Lightwave logic grade out?
Analytically, it earns a speculative bullish score of 7 out of 10.
7 out of 10, okay.
Yeah. The core thesis is that Lightwave's logic represents a premier, albeit high-risk speculative view on the AI photonics supercycle. Their perkinamine polymer provides a highly defensible intellectual property moat. They've validated their reliability, and they are locking themselves into the world's leading foundries.
But patience is entirely non-negotiable here. It is viewed strictly as a multi-year play.
Without a doubt. This thesis is designed for people who possess the stomach to ride out severe whiplash-inducing volatility until the second half of 2027.
So the immediate action plan for anyone tracking this space is to basically use the Q3 2026 tape-out returns as your first major validation checkpoint.
Exactly. If those physical chips perform, the long-term thesis remains completely intact. If they fail, the thesis breaks.
You know, if you're following the AI space, it's so easy to get caught up in the headlines about the newest language models or the trillion-dollar valuations of the companies designing the massive silicon chips. But the infrastructure supporting this intelligence explosion is hitting a very real, very physical wall.
Yeah, you have to look deeper into the supply chain. You have to look at the companies engineering the core materials that will actually allow these systems to communicate without literally melting down the power grid.
The hidden value of any gold rush is rarely found in the gold itself. It is found in the companies manufacturing the specialized picks and shovels. And in the era of artificial intelligence, those picks and shovels are clearly made of electro-optic polymers and advanced photonics.
So true.
Which leaves us with a final, lingering thought to explore today. As artificial intelligence models continue to scale exponentially, we know the bottleneck is no longer compute power. It is the physical limitation of moving the data itself.
Right.
If Lightwave Logic's polymers truly become the industry standard, replacing rigid, power-hungry materials in data centers worldwide, are we looking at the beginning of the end for traditional silicon architecture? Is this the tipping point where organic, molecularly engineered materials become the new, frictionless backbone of global technology? It is certainly something to ponder the next time you query an AI and expect an answer at the literal speed of light. And with that, don't forget to like, subscribe, and comment underneath. And once again, make sure you click that VIP Algos link in the description below to elevate your market analysis. Thanks for tuning in.